Good morning and welcome to the Coffee and Cap Rates podcast, your go-to source for New York City's latest commercial real estate insights. This program is brought to you by Ariel Property Advisors.
Hi, everyone. This is Shimon Shkury with Ariel Property Advisors coming back to you with Coffee and Cap Rates, our podcast. And today, very excited, very excited to speak about Brooklyn. Sean Kelly, my partner here. Hi, Sean.
How are you, Shimon?
Doing well. Thank you for being here. And Stephen Vorvolakos, who's one of our directors in Brooklyn as well. Hi, Stephen. How are you?
Hi, Shimon. Doing well. Always happy to be here.
Excellent. We're going to talk about 2025. What happened? We're going to talk about numbers. We're going to then try to figure out what to expect in 2026. And what was interesting in 2025 is that overall, the dollar volume of transactions was lower by 8%. The volume of transactions was almost flat, same with the building volume in general. What I found super interesting and very aligned with policy incentives is the development market. It grew by so much. We're talking about a 41% growth or dollar volume of growth to $1.8 billion last year. Sean, you've done a lot of deals in development last year. Tell us a little bit about the market, what's happening there, why people are buying, and maybe tell us about a few deals.
Sure. So, Shimon, last year was an exciting year for Ariel Property Advisors. I will take personal pride in an exciting year for our Brooklyn team. We closed 20 transactions in Brooklyn for $160 million. 13 of those transactions were development sites for $125 million. This is the largest increase in dollar volume and transactional volume since we were emerging from the COVID pandemic. So, blockbuster year for the Brooklyn market. Not surprising, and I say this every year on all of our podcasts, and I hate to be repetitive, but New York City suffers from a perpetual shortage of housing. Brooklyn is no longer seen as the redheaded stepchild to Manhattan, right? It is now a place where people choose to live as a matter of preference. So we saw development sites, for all food groups. So we'll talk about the three food groups. Affordable housing development sites sold. We sold a couple of those. 485X or 421A rental development sites sold. We sold 8 of those. Condo sites, both small boutique infill in Brownstone, Brooklyn, Williamsburg, highly desirable neighborhoods, and large scale ones sold. We had the great fortune of representing a long-term owner in downtown Brooklyn, where most of the product that's come online in the last, call it 5 to 7 years, has been rental. I'm going to say maybe 10 to 20% of the inventory that's been added to the supply in downtown was condo. We sold a development site in downtown Brooklyn at 245 Duffield Street, around the block from Acadia's City Point. We sold that for $310 a buildable. It was a record-breaking price for the condo land market in downtown Brooklyn. So incredibly happy for our team. More importantly, incredibly happy for our clients and the momentum that we're seeing in Brooklyn.
Yeah, that's pretty remarkable. I mean, I think that when we look at the policy changes, you look at two things. First, the grandfathered 421As, where you see bigger assets that are trading, like 175 Third, you saw Greenpoint Lending and others. They had the 421A before, but then you see the smaller sites are trading, and you ask, why is it that most sites that are trading today are building less than 99 units? It's because of the incentive. It's because of the 485X, where the government allows you to develop residential rental, but doesn't encourage you to develop above 99 units because there is a really high wage restriction or wage requirement there.
Something interesting that you mentioned, Shimon. Look, what we didn't really talk a lot about is City of Yes. So great initiative across the board, right? New Yorkers politically aligned with creating more housing, right? It's a great initiative. We're going to see in the short term, we're going to see more housing. I think it's something that we're going to see modifications to really align incentives. And I'll talk about that in a second, but also to modify it based on community districts and or neighborhoods. I think there's going to be some tweaks there. But when I say align incentives, we sold a development site last year where the increased floor area as a result of City of Yes allowed for almost, I want to say, an additional 50,000 square feet of floor area. It was a 50% increase in floor area that was allowed. However, I'm inclined to believe that the developer may not take advantage of the entire bonus because they only have to build about 30 to 35% of that additional floor area before to satisfy the tax abatement requirement. So I think that's something that the legislation has to look at. We really want to align the incentives for the tax abatement with the incentives to create more housing.
Completely agree. Incentives are the number one indicator for buying or investing in real estate here. And if the new administration, assuming they want to see more supply of housing, that's what they should be thinking about. How can we draw in capital so they can build more housing here? And I want to talk about existing assets and specifically about multifamily. And Stephen, what did we see there last year?
Yeah, so the story with multifamily has been largely the same over the last, call it 5 to 6 years. Investors are continually looking for free market assets that are tax class protected, don't have to deal with rent stabilization. They want income security in neighborhoods that are, really have strong fundamentals. So transaction volume increased 7% in 2025 compared to 2024. But the real story is 53% of these trades were free market properties in neighborhoods that, have this type of asset. So just to give you a couple of examples, Bed-Stuy, for the second year in a row, had 53 transactions, led the borough in multifamily trades. Park Slope, which Sean and I do a lot of work in, had 23 multifamily transactions, which was a 90% increase year over year. So investors are really looking for these types of assets that have these fundamentals in place. The problem is it's a sort of counterintuitive shift, right? We have people looking for free market assets, but price per square foot has gone down. It was $365 a square foot in 2025, the lowest since COVID. And cap rates have gone up to 6.96% on average in 2025, which is the highest in over a decade. So really what it comes down to is just cost of capital. Interest rates have kind of been on the rise for 2 to 3 years. They've stabilized a bit. And I think with that time period, sellers and owners are finally adjusting and capitulating. Buyers are seeing this as an opportunity to jump into the market and acquire properties at a lower basis. And finally, we're seeing these pricing metrics reset a little bit to reflect that. So to that point, fairly interesting example of how capital markets is affecting these multifamily trades. 125 3rd Street, which sold at the very end of last year for $105 million to the Carlyle Group. It's actually a development site back in 2023 that we sold when it was just land. So I'll let Sean speak to that, but this is a prime example of what we're talking about.
Appreciate the segue, Steve. So 125 3rd, great development site that we sold at peak pricing for $300 a buildable foot. Block through site, west side of the canal, Carroll Garden side of the Gowanus Canal. Classic institutional exit, except the developer probably would have liked to have held on to the asset, refinanced out of it. Unfortunately, given the cost of capital, it made more sense for them to take a small profit as opposed to refinance it, where they may have had to put equity back into the deal. But a sale to a Carlyle, we continue to see the institutional capital buying large rental buildings in the Brooklyn market. But we're going to see a lot more of transactions like this because of mortgage maturities, right? The capital markets haven't improved as quickly as a lot of people had hoped for or expected, may have been wishful thinking. And I think we're going to see a lot of builders who come into this situation in the next 12 months.
I think that's interesting, and both of you are bringing some really, really good points. Overall, there's about $936 billion of maturities this year, and we see that maturities are driving decisions. You mentioned 125 Third. There are many other assets that were built somewhere post 2015 with tax abatements now coming to maturity, some of them later coming to maturity from a mortgage perspective, and have to or want to sell versus refinance. So that's a super interesting phenomenon happening across the board, nationwide, not just New York City and not just Brooklyn. But what's interesting about Brooklyn is the amount of development and the amount of refinance that needs to go through here on the multifamily side. So it's definitely an opportunity for those who need to make decisions and those who have the capital. Now we're going to talk about retail a little bit. That's a continuation of the exciting parts that we've seen last year. Is that right, Stephen?
So the story with Brooklyn retail historically has always been the dollar volumes concentrated in North Brooklyn neighborhoods like Williamsburg, Greenpoint, and the transaction volume is concentrated more Southern Brooklyn, mom and pop corridors that typically drive the total transaction amount. So in 2025, we actually saw a decrease in dollar volume of about 17% year over year. And that's because the institutional buyers, for the most part, were not buying in those Northern Brooklyn neighborhoods. Acadia actually purchased 2 retail pieces on North 6th Street that were the 2 largest transactions of the year, totaling about 125 million total. But outside of that, we really didn't see a tremendous amount of institutional capital. It was mainly the smaller mom and pop shops that were driving activity. So slightly down. I expect it to bounce back. There's no reason that it won't, but just an interesting pattern that we noticed.
Thank you. And that really wraps it up for us. I want to ask both of you, and let's start with Sean. What do you see for this year, for 2026? If we had to guess, is it going to be more volume of transactions? Is it going to be higher value? Where do you see things, Sean?
I think values will go up. I think volume will slight uptick in volume nominally. Look, Shimon, what excites me the most and what's encouraging is to see for the first time that the New York City housing crisis is taking center stage in the ballots, right? I think what's going to happen, right, and we saw this, right, because there were housing-related proposals aimed at expediting land use changes and focused on creating more housing. We need more housing across the board. We need housing for our low-income New Yorkers, moderate-income New Yorkers, wealthy New Yorkers. We need affordable housing, we need free market housing, and we need for-sale product. They're also talking about bringing back a for-sale program, which is also a great way for lower-income families to invest in their future. So I'm really happy to see that this is taking center stage, and I think that this is something that, politics aside, everybody can rally around.
Thank you, Sean. Stephen, any last words?
Yeah, I think Sean hit the nail on the head. I'm optimistic 2026 will be an active year.
Thank you both. That concludes our Coffee and Cap Rates about Brooklyn. You should look at or review our report for Brooklyn. We look forward to speaking with each and every one of you. Thank you.